Hey everyone, welcome all to the webinar Climate Investment Opportunities Updates from the Lab. We're very excited to have such a large and truly global turnout of almost 300 registered attendees for 71 countries. We are really honored to have you here today. Before we start, a few housekeeping items. This event is being broadcasted live on YouTube, so the recording will be available there afterwards. We will share the link with all of you who registered for it on Zoom. Today, you watch a series of presentations from climate finance innovators who have been through the Lab Accelerator program. After each of them, there will be a Q&A segment. If you have any questions, type them on the Q&A feature on Zoom, not the chat, but the Q&A. You find the icon on the toolbar at the bottom of your screen. Our goal today is to answer all questions, either verbally or via text. Given the time is limited, teams will follow up via email for anything we can get to today. So we encourage you to continue the conversation. If you're watching it live on YouTube, use the comment section to type your question. Our team is checking this too. And with that, let me turn over to Ben Rocher, Associate Director at Climate Policy Initiative. Hi, Ben, over to you.
Hi, Julio, and hi, everyone. Thanks so much for joining this lab webinar. So over the years, we've had a number of lab members and others in our network express interest in the status of past lab instruments now that our portfolio has grown considerably over the past several years. So we're excited to offer this webinar as one of hopefully a regular set of opportunities to discuss the progress our portfolio has made recently, as well as share details on several lab instruments from previous cycles. This webinar will be moderated by my colleague, Carla Orrego, who is the lab's portfolio project manager. She'll present an overview of progress across our portfolio in recent years. And then we'll hear from three lab proponents that are on the line from past cycles. Each one will share a brief overview of their instrument that they developed with support from the lab and highlight their journey since the lab process has ended and share some initial impacts and their current fundraising objectives and priorities. As a brief note, we originally planned on having the team behind Climate Adaptation Notes, an instrument from our 2020 cycle today, but due to some unforeseen conflicts and some last-minute travel, they're actually no longer available to present today. So if you're interested in learning more about their project, please reach out to Carla or I, and we'd be happy to put you in touch with their team. Our first presenter today will be Karsten Young, whose instrument, Global Renewable Independent Power Supplier, or GRIPS, was a 2006 Fire Awards recipient, which was what was a sub-program of the lab. Karsten serves as the Structured Finance Manager at GRIPS Energy. Since then, they've really made a number of significant progress milestones, so it's going to be interesting to hear from Karsten. Second, we have Luis Laranja, who's Director Partner at Caite Investimentos. He'll be presenting his 2018 instrument, the Socio-Climate Benefits Fund, which is now called Kopura. Finally, we have Mark Ellis-Jones, who's the Managing Director at Ecosystem Equity. Mark's instrument, the Climate Smart Lending Platform, engaged with the lab in 2016, and he's also had a number of key developments since then that he can share in terms of impact and fundraising and where they're going next. So we're really excited to hear from all three of them. Just very quickly, for those of you who aren't familiar with Climate Policy Initiative, the Secretariat for the lab, we're an analysis and advisory organization, and we work with governments, businesses, and financial institutions to drive growth while addressing climate change. We're a global institution with offices in Brazil, India, Indonesia, the UK, and the US, and our vision is to build a sustainable, resilient, and inclusive global economy. So just to sort of set the scene here, according to CPI's latest estimate, global climate finance flows reached about $630 billion on average in 2019 and 2020 annually. This is the highest on record, as we've really seen public and private sector investments and ambitions in climate growing steadily over the past several years. Though it's worth noting that this growth rate has been worryingly declining, in fact, over the past couple of years. And I'm sure this will come as no surprise to anyone on the call, but while these numbers may seem large, they're still far, far behind the many trillions needed for a successful low carbon transition. There isn't really a definitive estimate of total finance required to achieve global climate goals, but it's clear that the incremental increases in climate finance, like what we're seeing now and what we've seen in the past, will be wholly insufficient, with pretty disastrous impacts for the people that live on this planet and the planet itself. So we really need trillions in climate investment, and we need it now. So in response to these challenges, the lab was launched in 2014 as a coalition of public, development, finance, and private investors to really play a key role in bridging the climate investment gap through identifying the best ideas to unlock emerging economy climate investment, building these into bankable financial instruments and products and companies, and supporting their pathway to market. So far, we've launched 55 of these solutions, which Carla will talk about in greater detail in just a moment. And the lab really relies heavily on our network of over 70 governments, development banks, philanthropies, and private investors who actively contribute to the development of each year's selected ideas. Over the past 6 years, the lab has mobilized over $3.2 billion US with finance from our membership, unlocking significant co-investment, including over $1 billion from commercial banks and institutional investors, the very sources of capital that we desperately need in emerging economy climate projects. So with that, I'll go ahead and turn it over to Carla, the lab's portfolio manager, to set the scene and walk through some of the progress across the lab portfolio overall. Carla, over to you.
Thanks, Ben, and hi everyone. Thanks for joining today. My name is Carla Rego, and I'm the lab portfolio manager. And for this section, I will give a detailed overview of the lab portfolio. So the lab is an incubator program that, as Ben mentioned, develops innovative financial mechanisms that can attract private capital into climate change mitigation and adaptation in developing economies. The lab has a portfolio of 55 instruments, of which 38 target mitigation, 8 target adaptation, and 10 both mitigation and adaptation issues. In the graph at the right, we can see the evolution per year of the instruments developed by type of climate action. And historically, the proportion of instruments addressing mitigation issues has been 4:1, but we can see an uptick since 2018, incorporating more adaptation in the operations. Next slide. So these 56 instruments operate across geographies and in critical sectors. Most has been focused on energy and in Africa. We classified the instruments in 5 broad categories and 10 or 12 subcategories based on our portfolio composition and depending on the level of detail requested for reporting purposes. That said, in some cases, we have overlaps or solutions addressing more than one issue. So for example, we can have water and sanitation infrastructure projects in urban areas. In terms of the regional breakdown, most of the solutions in Latin America and Asia come from our Brazil and India labs. And in Africa, everything is focused in sub-Saharan Africa. The global bucket refers to instruments with a wider regional scope, but always in developing economies. Now, we've mentioned that the aim of the lab is to develop sustainable financial solutions that can attract and catalyze private capital. We refer to these solutions as instruments, which are any type of financial mechanism that regulates the flow of financial resources into projects and then the flow back to investors. So an important distinction here is that these instruments are financial structures and not projects or products. They enable the financing of a set of projects aiming to achieve higher scalability. So for instance, think of these financial structures as the way of flowing money into a group of projects. As you can see in the slide, the lab employs a diverse set of financial mechanisms. This can be from structured products, including private equity, private debt, and securitization, to pay for performance mechanisms like impact-linked bonds and payment for ecosystem services. All these structures are used to deal with the different financial risks related to creating financial solutions. There are many financing barriers limiting climate transactions, and common issues go from the need of pre-financing costs, high upfront investments, to risk-return misalignment and lack of information. So the lab's structuring approach is focused on incorporating the risking and capacity building measures in this financial solution to address these key barriers. One way is, for example, to use blended finance structures, which make possible to match financial actors with their appropriate risk-return profiles, allowing them to achieve their own objective and catalyze further investments. Next slide, please. So looking into the portfolio, we can see that the most widely used financial mechanisms is structured products. And in particular here, we have private debt and private equity. Next. So we can group this in 3 tiers. The second tier is becoming more popular, and these include asset finance, typically in the form of leasing models, data tools like modeling and measurement, and servitization, which is a pay-per-service model applied to different offerings like cooling technologies. In the third group, we have hedging mechanisms, which are derivative using basically swaps and option strategies. Then we have insurance schemes that can be performance-based or guaranteed annuities, and more straightforward fixed income structures using bond and notes. Next slide, please. So with that bigger overview, now let's see how the portfolio is performing and where the money is going. The lab has 40 active instruments out of the 56 that it has developed, which means that it has a 33% of instruments conducting operations. This includes instruments along the whole development process spectrum, from proof of concept stages to scalability and replication stages. Of the remaining instruments, 3 are on hold, which means that are looking for either implementation partners or working capital to start working on the instrument, and 12 are inactive, which are those no longer pursuing the idea. In the numbers at the right, we can see the activity by sector and geography. Or another way to see it is as the rate of failure of the instruments in the portfolio. However, it is important to analyze here that these percentages should be assessed along other KPIs and not standalone. So for example, the climate resilience operative is 100%, but it only has 2 instruments, and despite this have been very successful, it is not comparable with the 64% of the energy sector that comes from a bigger base of 25 instruments. One additional thing to note here is that the main reasons for instruments failure have been lack of market fit, issues with the team, and change of focus or prioritization in operations. One or more of these reasons, coupled by funding constraints, led the 12 instruments mentioned before to shut down operations. Next slide, please. In terms of capital flows, the portfolio has collectively mobilized, as we already mentioned, 3.2 billion across 30 instruments in the portfolio. This represents a 54% success rate over the entire portfolio, which is higher than other incubators and accelerators. And this is also not considering 4 instruments that are self-funding their own operations, which if we add to the equation, this would increase the success rate to about 61%. In addition, we are tracking on top of this 3.2 billion at 400 million approximately in soft capital commitments that we hope will be made public or materialized during the rest of the year. So that said, one of the most exciting figures is the funding split, shown in the graph at the right below, which now is about half and half for public and private capital raise. This is very significant since the lab model fosters the development of solutions that will use small amounts of grants and concessional capital and grow into self-sustaining instruments that can create impact at a scale and crowd in private capital into climate action. So now let's see, next slide, please, the capital attribution of the portfolio by different types of breakdowns. First, we have by climate action. Most of the capital flows are for mitigation solutions, and this is in line with the number of mitigation and adaptation instruments that we have in the portfolio. One important thing to note here is that instruments from initial cycles targeted primarily mitigation, so considering the 3 to 4 year period it takes instruments to be fully implemented, we see more capital concentrated in mitigation solutions. To the right, we have the regional breakdown. We can see that most of the flows goes to instruments with global scope. And this is because of two reasons. The first one is time for development, and the second one, accessibility for investors. So here again, most instruments from initial cycles have a global focus. And in the second reason, most of the instruments with a specific regional focus look a need for local investors. And on top of that, there is some currency issues that they have to face. Next slide, please. Now, moving on, we have here the sectorial breakdown. As shown in the graph, energy is a sector that receives more financing, renewable energy in particular, and land use the most underfunded sector. Next. Here we can see a further split by subsector and highlight the significant shares, for instance, for urban infrastructure and energy efficiency. We can also note that water, cities, and climate resilience are more efficient sectors attracting capital flows, given the number of instruments in each category that were developed, as well as are the current active instruments in the portfolio. Next slide. So finally, we have a breakdown by financial mechanisms, like the matrix we see before, and the type of investment vehicle. Capital flows are going by far to structured products, and usually the preferred investment vehicle for that are funds. Then we have an almost even split among hedging mechanisms, insurance schemes, and asset finance models. Next. If we do a further breakdown here for structured products, we can see that most financing is concentrated in private equity funds. Despite that private debt funds in the portfolio outnumber the private equity funds, seems like investors prefer the latter. And this has two main underlying reasons, but not the only ones, but worth highlighting, which are the sectorial focus of these funds, because most private debt funds are for land use applications and capital flows into that area are slower. And two, the attractive market rates. So investors prefer more market rate of returns, and these are more typically found in private equity, which preferred sectors are energy, infrastructure, and water. So we can see a correlation there. Next. No, go back, please. So lagging far behind, we have data tools, servitization models, fixed income products, and pay-for-performance mechanisms. In many cases, this can also be explained by a sectorial association, because this type of instruments are applied to more challenging sectors and have usually more bold theory of change. So finally, next slide, thanks. Here, this is just a snapshot to assess the magnitude of the capital attribution by sector and geography. In the graphs at the left, you have the number of instruments, and at the right, the capital mobilized. So the idea is to highlight how much of the money is going to energy and solutions with a global scope, how water is the most efficient, attractive financing, and that the land use is the most underfunded sector, as well as solutions focused in Africa. So now let's hear concrete examples of instruments applications and how this can generate more climate transactions. We have three proponents here today with us. And as Ben mentioned at the beginning, they will talk about the instrument's evolution, how this instrument work, some milestones achieved since they were endorsed, and current funding opportunities. And with that, I'll leave you with our first proponent. Over to you, Carsten.
Thank you very much for the intro, Carla. As mentioned, my name is Carsten Jung, and I will introduce Scripps Energy today. Next slide. Kryptos Energy is a renewable energy as a service company and part of the Econex group, which is a European impact investor with 30 million euro raised in its previous financing round. Kryptos was funded by sector pioneers from Deutsche Bank, Solon, and Unicos with track record of more than 500 megawatt of renewables in 25 countries and more than $800 million funding closed so far. Next slide. Why we're doing what we're doing. Growth of SMEs, as you know, in Africa is hampered by a lack of reliable, affordable, and clean electric and thermal energy supply. Cost of electricity alone in African countries is on average 15 cents per kilowatt hours and rising. At the same time, grids are unreliable, which leads to approximately 1/3 of the power demand being generated through backup generators. Process heat and backup generators are often diesel-based and at the same time run inefficiently. And all of this makes current energy supply very expensive for SMEs. Although renewable energy solutions are cost competitive given the above, SMEs don't have access to appropriate long-term funding to finance the high upfront costs of those solutions and fear the technical risks. To respond to this, Kryptos is financing and operating the renewable energy assets on behalf of the SMEs. Contracts that we offer can be PPA or leasing type of agreements with contract lengths between 10 and 20 years. And after this, we transfer the ownership of the assets to the SMEs. Power is provided to SMEs against periodic payments until the investment costs are paid off. As a unique selling proposition, we offer thermal and electric renewable energy solutions beyond solar PV with system sizes between 0.3 and 15 megawatt, so quite a range. Solutions are shown in the table on this slide and include solutions for the food, water, energy nexus, such as cooling or irrigation technologies. Where we're active, we provide solutions for SMEs in sub-Saharan Africa. We're currently actively pursuing projects in 12 countries and are operating out of regional hubs in Senegal, Uganda, Zambia, and Ghana. To maximize in-country value creation, we focus on executing projects together with in-country project developers and or in-country EPC companies. What have we achieved so far? In Zambia, we have developed and financed a 99 kilowatt peak PV system with a 127 kilowatt hour battery for a food processing company. The system allows the company to avoid any type of diesel generation. Construction and operation have been carried out by a Zambian EPC contractor, as I mentioned on the previous slide, which is our typical model. Next slide. After an activity slowdown during the pandemic, we are now back on track and currently implementing former projects in Senegal, Uganda, and Zambia. 2 of these will be finalized this year and another 2 by early next year. So the 2 this year will be Senegal and Zambia that you see on top here. Beyond the secured pipeline of 5 projects with a volume of $2 million, we have a concrete pipeline of approximately 29 SMEs with a funding volume of $22 million. These are all projects, leads that we have submitted proposals to and are actively discussing at the moment. Next slide. Yeah, thanks. As mentioned, we're currently targeting projects in around 12 markets out of regional hubs, being Senegal, Ghana, Uganda, and Zambia, where we have our own development and sales staff. In addition, we're building partnerships with in-country project developers and EPC to scale the pipeline. We thereby focus on SMEs where we see the potential for upselling solutions beyond solar PV during the contract lifetime. Our management team is based in Berlin and Senegal and has a track record of building more than 500 megawatt of renewables in 25 countries, as mentioned in the beginning. Beyond renewables, Amadou and Ursula have more than 10 years each experience of business development and sales across different B2B markets in sub-Saharan African countries and are leading our sales and business development activities. Now talking about the money. In order to finance the construction of our pipeline, we're initially seeking external equity financing of $10 million, with $1 million already committed by our parent Econex. Once initial equity is committed, we'll leverage the equity through senior and junior debt to a total portfolio size of $15 million to be spent within the next 5 years. Kryptos will carry the project development risk and only look for external financing for the construction of assets. So the project development will be carried out out of the scope of this asset company. Instead of charging a fund management fee and to assure aligned interest, Kryptos proposes to remain shareholder on asset level. Econex will take a junior equity position compared to external equity investors in the waterfall structures. For external equity investors, we're targeting a 15% equity return over the asset lifetime, as I mentioned, without having to take any project development risk, as groups will take care of this. The final structure of the first phase consists of 20% equity, 20% junior debt, and 60% senior debt or bond equivalents. As a viable exit option for equity investors, we provide the option to sell to a long-term infrastructure investor through listing the company as a yield co. As said, we will not charge a management fee, but remain shareholder on asset level instead, which is quite unique. To sum up, we're offering a 15% target return and targeting to raise $10 million equity by the end of 2022. Thank you very much for your attention and looking forward to the Q&A session.
Thanks a lot, Karsten. Definitely a very interesting instrument with a unique structure that we have in the portfolio. So now let's move to the Q&A section. Attendees, please submit any questions you may have in the Q&A feature. And we can start, we are receiving some questions, but we're going to start with these questions about what makes the grid business models different to other actors that are active in the commercial and industrial space in sub-Saharan Africa. Can you elaborate a little bit more on these differentiating features?
Yes, thank you very much. It's not the first time we're getting this question. Well, I would say from a business model point of view, a unique select proposition is really that we offer solutions beyond solar PV and storage, since we're also focusing on thermal solutions, as well as solutions in the food, water, energy nexus, such as irrigation or solar cooling, which I think is a little bit different to other actors currently active in the C&I space, or most of them at least.
Great. And along those lines, we have a question in the chat asking if you're able to manufacture or fabricate your own PV panels, but this can be applied to any of your products in Africa, so you can reduce the embedded carbon footprint in your operations.
Yeah, I mean, we're not like a manufacturer of solutions. We're essentially like a project developer, investor, and asset operator. So we, work with, as I said, in-country project developers and EPC companies that will act as partners for us for the implementation. And they will always work with, tier one equipment that is considered bankable and an important factor for all the financiers. But that doesn't mean that this cannot be manufactured in African countries, but it will have to adhere to the, standard quality certifications.
Oh, okay, great. Thanks for the clarification. And maybe we can move into the pipeline. Can you tell us a little bit more about the pipeline? You mentioned you have some projects already secure, some projects under negotiation. So if you can expand a little bit more on that. Yeah,
we have been making quite a bit of progress this year. So we have one project up and running since late 2018 in Zambia that I introduced during the presentation. This year, or end of last year, and this year we have secured 4 more projects, which gets us to like a total pipeline of around 2 million at the moment, where secured pipeline. The remaining pipeline that is provided as an annex to the presentation is like we're actively discussing with 29 SMEs in 12 countries in sub-Saharan Africa, where we have submitted proposals and are in active discussions. It's around 27 million total pipeline. Of course, we're discussing with more SMEs beyond this, but this is what we consider kind of like as a concrete pipeline that we're pursuing at the moment, and it consists quite a bit of solar PV and battery solutions. But as I said, we often see solar PV and battery as an entrance to collaboration with SMEs, and then further working together with the SMEs on providing them thermal solutions or energy efficiency solutions as well.
Great. Yeah, thanks for the overview. We have also more questions coming on the chat. I'm gonna aggregate a couple of those. In terms of, let's move now to the financial structure. Maybe you can start saying why this is unique and different, and touch a little bit on the management fees. We have Angela asking more about how that works. And for instance, how many shares do you keep for those, as you described when you were talking about the structure?
Yeah, sure. That's an interesting one. Yeah, we think it's a unique structure because first of all, it's like an infrastructure type of investment opportunity where the investor does not have to take any project development risk, which is carried out of the asset company. And rather than charging a fund management fee for the project development and the operation of the assets, we are proposing to keep 25% of the shareholding on asset level as Krips Energy, and we will be paid or benefiting from dividend payments then over the asset lifetime. So our plan is to kind of stick along as long as the asset or as long as the contracts are running, and which we think also makes sure that there's an aligned interest between all parties.
Okay, and along the structure lines, there is a question that asks about if you will consider a different split on the capital structure. So for example, consider financing of 25 million on a 70 debt and 30 equity split.
Yeah, I mean, we're generally flexible, but we would have to model and see where we get with the numbers, of course. But this proposed structure is more or less something that we have been testing a little bit with the sector, but it's not completely set in stone.
Yep. And now moving maybe on the development side, we have a question asking if how would you consider, what would be the requirements to work with different SMEs and that they can collaborate with the GRIPS model, or on the project development side?
Yeah, well, I mean, we focus on, as I said, SMEs where we see potential for growth of the SMEs. Of course, we can do a credit risk assessment of the SMEs before entering into any contract, as any bank or leasing provider, would do. And we need to see, potential for savings achieved by the SME with the solutions that we provide. So unless there's a very strong motivation, for instance, because of CO2 emission reduction requirements of the SME, we would not invest into a solution where the SME doesn't benefit at least or make savings of at least 15% on current energy consumption. And as I said, there needs to be a technical potential for 0.3 megawatt or 300 kilowatt peak up to 15 megawatt. And we would look at this a little bit like from a total energy or renewable energy potential. So not only on the electric side, but also on the thermal side. So there are SMEs where we are in talks. We first invest into like a 200 kilowatt peak PV system, but see the potential to in 3 years from now to install a thermal solution as well.
Perfect. Yeah, very clear. Maybe we can close with a measurement question. We have a question in the chat from Moya asking, how do you quantify or manage your counterparty risk?
We have developed an internal scoring tool that will, score the SMEs. We'll consider different aspects, like it is typical in a normal SME scoring model provided by the big companies. Although we're doing it at a bit of a smaller scale. At the same time, we're considering, ESG reputational risk as well into our assessment. So whoever's interested in working with us, we will of course make available our scoring model that we apply to all SMEs.
Great, thank you very much, Karsten. Again, this was very helpful. Feel free to answer. There are some unanswered questions in the chat, but to follow up with those. And now let's move to our second proponent. Over to you, Laranja.
Thank you.
Thank you, Carla, and thank you for the lab for inviting again for this presentation. It's a pleasure to be here. I will present the case of Kopura Agro Pastoril. Kopura is an anchor company that produces, that develops and promotes integrated crop livestock forestry system. And at the end, they produce high quality protein, as I will show in the next slide. Yeah, next slide, please. Kopura is composed by a group of senior entrepreneurs with a huge experience in different sectors, public, private, NGO sectors, as well as in the finance sector. We have guys that worked on the field in operational companies, as well as in the finance side of the business with a lot of experience. Next, please. Well, the problem that we are addressing is connected with the challenge of the climate change. Of course, the climate change is the highest challenge that humanity has today to address. And when we look this challenge, there are two issues that we should address. The one is energy. And second is land use. So here we will talk about the land use side of the problem. And when we look at the land use, it's important to understand how land is used today in the world. And when we check the data, we see that 77% of the land is used for livestock production. Sometimes people don't really pay attention about this number, this data, especially because there's like a hype today of alternative proteins. But when we see the real data, and we can see in the next slide, actually, the traditional proteins are not decreasing. I mean, the consumption is not decreasing. When we see the forecast, we have a number of 14% increase in the meat consumption until 2030, as well as milk, 1.7% of increase per year. So actually, at the end of the day, the land is being used for livestock, and the animal protein will be increasing in the next few days. So if we really want to address the problem of the climate change, we should prioritize the redefinition of the livestock production system. That's what we are doing with this company. Next, please. Kopura is, as I said, is a holding company that produces carbon neutral products. And we are investing in different business model with different kind of animal protein in a system that is integrating crop, livestock, and forestry in a whole integrated system. We are based in three main pillars that are animal welfare, low use of chemical inputs, and sometimes we are talking about organic production, as we will see, and low carbon emissions. Next, please. So what we define is that we should put the tree at the center of the production system, and that there's a lot of advantage of doing that. The trees provide comfort for the animals. Sometimes it provides feed for the animals. It provides nutrient for the soil. It could increase the productivity, reduce the costs. At the end, it could generate healthier food products, and we could attend the growth market for conscious consumer, and we have a strong carbon sequestration at the end of the day. Next, please. So here's the innovation. As I said, we are an anchor company that develops, produces, and promotes this integrated production system, the innovative integrated production system. So our system is based on the model from farm to table. So we have a farm, we process the food, and we deliver the food at the end. We create a commercial brand, and we promote the integration and support for smallholder farmers, including technical assistance and the guarantee of purchase of the product at the end. Next, please. So here's the structure. We have a holding company on the top, and we have in the left side the Kopura Dairy that deals of course with the dairy products, and in the right side the Kopura Livestock that deals with pork, chicken, beef cattle. And I will highlight the Kopura Dairy because Kopura Dairy is more advanced right now. Next, please. So we have operation in 3 different states in Brazil, in 3 different biomes. We are operating in the Atlantic Forest in São Paulo State, in the Amazon Forest in Mato Grosso State, and in semi-arid at Bahia State. Next, please. Here you can see a picture of the farms. This is Guaraci Farm in São Paulo, where we produce organic milk, organic certified milk, animal welfare certified, and carbon neutral milk. Next, please. This is Aurora Farm in Bahia, where we are creating a farm right now. We are structuring the farm to amplify, to expand the milk production, organic milk production in another farm. So this is in the beginning phase. Next, please. And here we have a beef operation in the Mato Grosso, fully integrated with the forest. Second, next, please. Here is the first product that we launched. We launched in the market. We created a brand that's no carbon milk. It's the first carbon neutral milk in Brazil. It's organic, as I said, organic certified, animal welfare certified. We are in the market right now. Next. The products were launched 8 months ago. Right now, we are present in more than 300 stores and outlets in 6 different states in Brazil. And we had a wide exposure in the main newspaper and magazine of Brazil. Next. So here is the numbers of capital that we raised until now. We have some equity investment, with some debt from different sources, starting with the capital from the founder, angel investors, a concessional capital, and we have some debt from Brazilian banks and other institutions that work with impact investment. Next, please. So now we are planning to expand the operation. We have the opportunity to scale to increase the scale of the operation in São Paulo, where we are producing the milk today. We can double the production. Until now, we work like a lab operation. I mean, we were testing the model, and it's okay now, so we are ready to scale. We will start a new operation in the Bahia farm, and our plan is move from 4,000 liters of milk per day to 120,000 liters of milk per day. In the beef business, we are consolidating and expanding the production in Mato Grosso State, as well in the swine and poultry operation. Next, please. So at this moment, we are organizing a fundraising, and so we are looking for an equity investment at Kopura Dairy of $10 million, at Kopura Livestock, Kopura Beef, $5 million, and of course, we have a space for concessional capital to support the smallholder engagement in the value chain. thank you very much, and I will be. It will be a pleasure to answer any question you have. Thank you.
Thank you very much, Laranja. Yeah, it's super interesting to see how this has evolved, and very exciting that you already launched products since endorsement was a huge step. Sorry. I have to put my video on. Just a reminder for attendees that if you can post your questions in the Q&A feature, and now we can proceed with the Q&A. So maybe we can start with a more general question about the implementation plans you have for your beef and poultry products. You can give more details on what are the next steps on those, explain why are you fundraising commercial equity to expand those operations. So maybe can give us a sense of the use of funds of those capital requests.
Yeah. Well, actually, in the beef, poultry, and swine operation, our plan is to launch a new brand that, of course, will be a different brand. That's no carbon milk is for the dairy operation, for the dairy part of the business, and we are planning to launch a new brand of sustainable meat. So that will be our focus right now, as well as the expansion of this the farm. We have a very small operation, poultry. Let's say a reasonable operation of swine, and a good operation of beef. But we should expand once we are very comfortable with the model of the system now, so we can expand the production, and in a few months we will be ready to launch a new brand of sustainable meat.
Great. Yeah, that's very helpful. And we have a lot of questions in the chat about land acquisition. So one, if you have plans of acquiring more land, and second, if your business model is about acquiring all the lands and then turning around businesses from scratch or partnering with other companies, maybe you can elaborate a little bit more on that.
Mm-hmm. Yes. Well, our philosophy is to have a significant part of the production being supplied by our own farms. But once we have developed the system, and once we have a full confidence in this integrated system of production, we are ready to promote the system for other farms, and so engage especially smallholder farms in the supply chain as supplier partners, so we can provide technical assistance, maybe finance, and we can guarantee the purchase of this the end products of this farm. So we have a small scale project running right now with the support for smallholder farms in the dairy operation. So that's our perspective. But I'd like to emphasize that our plan is to have a significant part of the production coming from our own farms. That's a strategy to guarantee a high quality and a sustainable supply of the products that we need to support commercial brands.
Okay, yeah, very interesting. We have many questions coming about carbon credits. So yeah, I mean, there's been a lot of attention on the potential of agroforestry and sequestering carbon in the Amazon. So maybe you can give us a bit of insights on what are the challenges you've seen in these sectors, how these can actually take the solutions to the scale needed, and then maybe answer if you're able to issue carbon credits from these activities.
Yeah, that's a good question, Carla. Actually, I will give you I will tell the situation about the dairy operation where we have a carbon neutral operation. So in order to have a carbon neutral operation, we are planting trees in our farm and based on a methodology that we apply for this carbon neutral certification. We quantify how many trees we need to plant in order to neutralize all the emissions that we have in the production side. And when I say all the emissions, it's not only the cows related emission. We count the fuel for the tractors, for the trucks, the electric energy for the refrigeration of the milk. We include even the package that we use for packaging the milk in the account of the carbon emission, and so we plant tree to neutralize and have a carbon neutral operation. Of course, we make maximum effort to reduce the carbon emission, but at the end, as you can imagine, in a cattle operation, we still have a carbon emission. So we planted trees to neutralize. So in this case, we don't generate carbon credits. Actually, what our perspective is to monetize this potential carbon credits we have by planting trees through the end products. I mean, we have a premium price in the milk products for the consumers, and so based on this premium, we can neutralize the operation. I mean, we do not sell carbon credits. We sell high quality products that are carbon neutral, and so we expect to have the carbon result in the price of these final products at the end of the process. So that's our strategy. We are not selling carbon credits. We are using the credits for neutralize our operation.
Okay, yeah, that's very helpful to know. We're over time, so maybe we can close with an interesting question here about the brand, and if your model extends to a franchise that can be used to empower community farms or land cooperatives.
We are open to discuss this kind of opportunity. We already thought about this potential opportunity, and so the answer is yes. We are open to discuss this opportunity.
Okay, very interesting. We have more questions on the chat, but we need to move because we are on time. You can follow up with them, and I think there are some follow-up questions regarding the land acquisition model and how do you use the carbon market. So with that, thank you very much, Laranja, and we'll move over to Mark. Mark, the floor is yours.
Hello, everybody. I'm Mark Ellis-Jones, the Managing Director of Ecosystem Equity. And this is an update on our progress since participation in the lab. That was in 2016, developing the Climate Smart Lending Platform concept, or CSLP. So, Ecosystem Equity develops early stage ventures, which increase the value of natural capital and have potential for transformative scale. At the time of our lab participation, we were called F3 Life, so a little bit of a change there. When we participated in the lab, we were at a relatively early stage of development. We piloted an approach we call Climate Smart Lending. Firstly, a farmer signs a loan agreement, and together with that, a land management agreement, setting out how they will sustainably manage their land. Secondly, the farmer repays their loan and also implements the land management agreement, the sustainable land management practices, which they had prior agreed. Thirdly, those changes are monitored. Fourth, verification of implementation is then fed back into the farmer credit score. And then fifth, the agri-lender can use our tools to report on their environmental impact that they've secured through the adoption of the methodology. As mentioned, that was a methodology that we piloted. And with the lab, we then developed the Climate Smart Lending Platform concept, or CSLP, which aimed to bring together the tools, actors, and finance necessary to reduce climate risk in lending portfolios and scale up climate smart lending to smallholders globally. When we participated in the lab, we were relatively early in our innovation process, and we've subsequently seen our participation evolve in several different directions, some under our control and some under the control of others, of third parties. So under our control, firstly, GreenFi, we've developed out of the lab concept a series of tools to build community-owned, community-managed green credit cooperatives, and this has reached a replication stage. Secondly, we've built OpenImpact.earth, which is a digital tool for verifying and reporting on ecological restoration and protection projects, and this is very recently launched. And thirdly, the CSLP fund, which aims to bring together or to provide blended finance to agri-lenders wishing to start climate smart lending, and for which we have an expression of interest from a cornerstone investor. Not under our control, but developed by third parties, but related to the CSLP concept, the Community Adaptation Facility is a Rwanda-only facility for climate smart lending projects. Secondly, Lend Access, developed by the Financial Access team, is a project which has developed a farmer credit risk scoring tool, which includes climate risk data that's recently launched, I'd say within the last year or so. And then the Global EBA Fund, thirdly, has provision for climate smart lending projects. Also not under our control are two concepts. Firstly, the Lake Naivasha Landscape Fund, and secondly, Landscape CPR. Both of those are concept stage. How does that evolution translate to funding? And this is, I think, is an update on our progress since we participated in the lab. Firstly, the CSLP fund raised a series of small grants, firstly from the Dutch Ministry of Foreign Affairs, and then Partnership for Forests to develop tools, and has recently launched a do or die point in its development, and it needs an injection of funding I'll explain shortly. Secondly, on the back of this funding for development of tools, GreenFi raised a little bit more funding to adapt those tools for building community green credit cooperatives. We've reached replication stage. And thirdly, OpenImpact.earth raised a further 20,000 and has recently launched. The Community Adaptation Facility, just as a tool outside of our control, we raised a small amount of funds to contribute to the concept, and then that was launched with an investment or with funding from a multilateral development bank. Just reflecting a little bit on some key lessons that we've learned. Firstly, climate smart lending, and then just advancing a little bit in the presentation there. Climate smart lending deals are slow to broker and with high broken deal costs relative to, I think, who we are as an organization. And those are costs that we are not structured to absorb. So what that means is that for us, secondly, and why the CSLP fund is quite important to the ongoing development of the concept, is that to facilitate deployment of private capital for climate smart lending purposes, it looks like the only scalable financial model is as a fund. And thirdly, related to that lesson, there is a strong perception that the majority of small-scale producers are not bankable in conventional terms, and hence we developed the Community Eco Credit System, which is a market-like approach dependent on seed grants, and really hits those sort of small-scale producers, or designed for those small-scale producers who wouldn't be able to access sort of credit issued by private actors on commercial terms. In terms of funding, and this is where there are some funding opportunities. Firstly, for the CSLP fund, we're looking for 350,000 euros to fund further CSLP fund development in partnership with a fund manager called Finance Earth. And this funding that we're raising is to replace funding we'd hoped to receive from a prior funder, but whose funding priorities changed at the beginning of this year. Following that, we estimate we need $40 million of concessional and commercial capital, and we already have an expression of interest for $10 million of commercial capital in place for that. So that gives us a sort of a cornerstone investor from which to leverage. And then in terms of Greenfire, which is our community eco-credit, we're looking for an open-ended amount to deploy. There's huge demand for this type of capital, but it is in a grant form. And that brings me to the end of the presentation, other than just to say thank you. And as a very quick plug, if you're interested in using our digital tool for verification, for monitoring, or for reporting on your own project where there's an ecological restoration or protection objective, particularly where there's a sort of performance-based element to it, it is open, and if you'd like a demo, you can contact me. So, thank you very much.
Excellent. Thanks a lot, Mark, for your presentation. It's actually great to see how the concept developed during the lab in 2016 has evolved in so many avenues and has achieved so much progress. So for the attendees, again, please feel free to post your questions in the Q&A feature. And maybe we can start with asking you if you can give us a little bit more detail on the fundraising that you mentioned. What does the 25 million in commercial and concessional finance need would break down? What is it going to use for? And maybe along that, tell us a little bit more about the plans for the CSLP fund.
So when we built the CSLP concept with the lab, we developed a sort of an indication of the type of sort of capital and sort of the breakdown of the sort of the commercial and the concessional capital that would be needed. Time has passed by, and that indicative view has changed. As mentioned, we've partnered with an organization called Finance Earth to potentially raise this fund, and they have a very sort of innovative way, or sort of appropriate way, by which they structure the capital that they're raising, and they do that through the development of a pipeline, and then build the sort of the capital structure around what that pipeline is actually calling for. So the capital that is then placed is immediately in demand and is appropriate to the need. So that's actually what we're raising the grant for, to sort of go through that process, developing that fund, and that will give us a sort of a precise indication as to who is going to who we're going to place capital with, and what type of capital instruments those organizations will need. So that's a view that subject to sort of finding that funding is going to be a picture that we develop in greater detail over the course of the year.
Great, that's very helpful. And for instance, related to the third-party operations that you referred at the beginning, is that something you still do, that you partner with other institutions to, for example, provide some know-how or the tools developed? Or how do you envision this going forward? So let us know if this is part of some of the projects you also pursue. Sure.
So we're a small organization. We're very much sort of focused on our sort of key focus is on sort of developing sort of innovative methodologies for increasing investment in improved land management. We're not an organization that can take large sort of funds of money, or large sums of money or capital to scale, and we're always going to look for third-party organizations who can do that where our objectives align. And we're happy for other organizations to sort of pick up concepts that we've developed and move them forward, as we have done with several others. But there are also instances where we see that the best way to continue developing a concept is within a new vehicle, and we're sort of open to doing that as well, particularly where sort of the capital needs are lower, for example, for a sort of a digital software as a service tool.
Yeah, that's very true. We have a question in the chat from Angelica. She asked, what is the target region of the ecosystem fund? I believe the CCLP fund. And how are you working with the smallholder cooperatives, and how are you doing the market connection?
That's sort of quite a sort of detailed question in a way. When we sort of passed through the lab, the idea was for a sort of a CSLP platform that would engage actors globally. As we're thinking about the CSLP fund, we're thinking with a sort of a priority focus on East Africa. That's where a lot of our experience comes from. So East and Southern Africa, and that's where the initial focus will be. And subsequent was subject to sort of some of our assumptions around our ability to sort of successfully deploy that capital. We'd start looking at other regions, but really it's that sort of focus in East and Southern Africa. Now, with regards to sort of farmer credit cooperatives, there are two ways in which those can be developed or approached. We actually, our model there is to work with third parties, so organizations which want to support communities, typically of small-scale producers, to develop these small-scale green credit cooperatives. And so it's those organizations which already have relationships with communities of people on the ground who would benefit from having access to this type of tool and this type of capital. So really, our position is in sort of providing these tools to these sort of third-party actors who have an on-the-ground footprint.
Okay, yeah, thanks for the detailed explanation. We are approaching the end of the allotted time, so maybe one question to close is related to the Open Impact Earth tool. You mentioned it at the beginning that it's available, but can you maybe clarify if it's available for non-CSLP projects and if everyone can access? We have some questions in the chat asking how they can contact you, so perhaps there's some interest about how accessing that tool.
Yeah, sure. And if I just move to the chat, I will just drop my email address there. And you can contact me for a demonstration. We can have a sort of conversation about whether it's going to meet your project's purposes. It is designed for some specific use cases, but that is relatively broad, and the tool can be adapted for specific use cases that we haven't considered yet. But it's very much, we built it to sort of to meet the CSLP need, but we realized while we were building it, by talking to people, that it would really have sort of a use beyond that specific use case, and a variety of projects which trying to achieve ecosystem restoration and protection, and once verifiability or verification that environmental activities have been taking place on the ground in order to better manage those.
Excellent. Well, thank you very much again, Mark. It's very exciting to see the next steps of this and how this is gonna continue to evolve. We reach out the top of our allotted time, so we are gonna grab the presentation here. Just please keep in mind that, like, to the audience and the attendees, that you can contact any of our presenters with additional questions after this call. And we will circulate the slide deck with their contact information shortly as well. So I am seeing in the chat that some people can see Mark's email, so you will have that information to review. So thanks again for attending, and hope you enjoy the presentation. And if you are interested in other lab instruments or ideas, go to the web and feel free to reach out to us as well. Thanks.
Thanks, everyone.